Understanding receipts, the essential document of financial transactions. A receipt is more than just a piece of paper, it is a critical document that serves as a formal acknowledgment of a financial transaction. Whether it's a consumer buying groceries, a business transacting with another company, or an individual making a banking trade, receipts play an invaluable role in ensuring that all parties understand and confirm the exchange of goods or services for payment. Key takeaways. Official record. Receipts act as official records representing proof of financial transactions or purchases. Scenario usage. They are utilized in various scenarios, including business-to-business dealings and stock market transactions. Tax compliance. Receipts are essential for filing taxes, serving as necessary documentation for deductions. Cash flow monitoring. In accounting contexts, receipts are often connected to tracking total cash inflows over specific periods. Tracking transactions. One of the primary purposes of receipts is to enable businesses and individuals to track their cash flows effectively. Companies use receipts to reinstate payments, verify and reimburse eligible payments to employees or vendors. Claim tax deductions. Substantiate expenditures when filing taxes, supporting claims for deductions. Essential receipt elements. While the exact format of a receipt can vary, it typically includes several key pieces of information. Date of transaction indicates when the transaction occurred. Nature of transaction provides details about what was purchased or the service rendered. Vendor information identifies the seller or service provider. Payment method specifies how the payment was made, e.g., cash, credit card. Taxes/additional costs breaks down any extra fees or taxes paid. Signatures. In certain cases, a signature from either party may be required. IRS requirements for receipts. The IRS mandates that individuals maintain documentation of certain expenses, emphasizing the importance of keeping receipts for various transactions. Taxpayers should retain these records for at least 3 years after filing, but specific situations, such as unreported income or bad debt deductions, may require records to be kept for 6 or 7 years. Recommended receipts to keep include gross receipts, cash register tapes, invoices, and Forms 1099 MISC. Purchases and materials, receipts for items acquired for business use. Travel expenses, documentation for work-related travel and transportation costs. Asset purchases, receipts for significant acquisitions like real estate or equipment. In today's digital era, the IRS has recognized the validity of digital receipts since 1997. According to Revenue Procedure 97-22, these records must be accurate, securely stored, and easily reproducible. Businesses must also be able to provide copies if requested by the IRS. The historical perspective on receipts. The origins of receiving documentation can be traced back to ancient Egypt. Farmers and merchants developed systems to document transactions to protect against tax exploitation. They utilized papyrus for record-keeping when paper as we know it today was not yet invented. In more recent history, banks in London embraced the capabilities of the Industrial Revolution and began printing receipts that featured their branding. Types of receipts. Receipts come in various forms, including packing slips, document details about the contents of a shipment. Cash register tapes, provide a summary of purchases made at retail locations. Invo 1 ICEs, issue requests for payment after a service has been rendered. Credit card statements, summarize all transactions made within a specific period. Petty cash slips, record small cash payments for incidental expenses. Though receipts may differ in format, their fundamental purpose remains, to document the details and value of any transaction. Receipts versus invoices. It's crucial to differentiate between receipts and invoices as they serve specific roles in business transactions. An invoice is essentially a payment request issued before the payment is received, while a receipt serves as proof of payment that has already taken place. Businesses often generate invoices following the provision of services, subsequently issuing receipts once payments are confirmed. Understanding gross receipts. Gross receipts represent the total cash or property a business receives before any expenses or deductions are considered. They are a vital factor for accountants in determining a firm's net income and profitability. Understanding gross receipts helps businesses assess sales performance and financial health. The bottom line. Receipts are foundational elements of financial documentation for both individuals and businesses. They serve as proof of payment, are essential for tax deductions, and help document expenditures on income statements as well as asset existence on balance sheets. A thorough understanding of receipts and their importance can aid individuals and businesses in maintaining proper financial records, ensuring compliance with tax regulations, and supporting smooth transaction processes.